What if the reason you got denied for a mortgage had nothing to do with how responsible you are with money, but everything to do with a reporting error you didn't even know existed? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today, we're talking about something that quietly affects millions of Americans: credit scores. Not the mythology around them, the real stuff. What's actually moving the needle in 2026. Let me start with the credit myth I hear most often. Ron, if I just wait, it'll fall off my report eventually. And sometimes that's true. But here's the problem. Sometimes it's not. And while you're waiting, that item on your report is quietly costing you loan approvals, better interest rates, and real opportunities. I had a client not long ago, sharp person, responsible with their money. They came to me frustrated because they've been denied for a mortgage. They figured time would fix it, just wait it out. When we actually sat down and looked at their credit report together, we found reporting errors, incorrect information, things that had no business being on there, and they'd been waiting on those items to just fall off for over a year. Here's the thing about negative items. Many of them stick around longer than you'd expect, and some of them update incorrectly, which can actually reset the clock on how long they stay. That's where having a strategy matters. Waiting is not a strategy. So let's talk about what we're actually seeing hurt credit scores the most right now in 2026. Number one, buy now, pay later accounts. These have exploded in popularity. You see them everywhere: online checkout, retail stores. What most people don't realize is that many of these accounts now report to the credit bureaus, and if a late payment is late, that can hit your score hard. Number two, credit card balances over 30% of your available limit. This one is huge. Your credit utilization ratio, that's just a fancy way of saying how much of your available credit you're using, is one of the biggest factors in your score. Keep balances under 30%. Under 10% is even better. Number three, authorized user accounts. A lot of people are added to a family member's credit card to help build credit. Smart strategy in theory, but if that family member has a high balance on that account, it can pull your score down just as fast as it helped build it up. Number four, old collections that suddenly update. You think something is done and gone, and then it updates. Maybe the collection agency sold the debt. Maybe there was a data entry error. Whatever the reason, that update can look like fresh negative activity to the scoring models. And finally, reporting errors and identity issues. If something on your report doesn't look right, trust that instinct. It probably is not. Now, here's the good news. Credit improvement is very doable. Here's what we're seeing actually work. First, fixing inaccurate reporting. You have rights under the Fair Credit Reporting Act. Errors can be disputed and removed. Anything that is not complete, accurate, and verifiable must be removed according to the law. Second, strategic disputes. There's a right way and a wrong way to dispute items. Over disputing can actually flag your file and slow things down. You want targeted strategic disputes. Third, paying balances down at the right time. This is interesting. It's not just about paying down balances, it's about the timing of when those balances report to the bureaus. A small adjustment in timing can make a meaningful difference in your score. Fourth, cleaning up authorized user accounts. If being on someone else's card is hurting you more than helping, it may be time to have that conversation. And fifth, building positive credit alongside your disputes. You can't just remove the bad, you want to strengthen the good at the same time. I want to come back to that client I mentioned earlier, the one who had been denied for a mortgage. After we reviewed their credit together, we found both reporting errors and utilization issues. They got focused, worked on the process, and within a few months, several negative items were removed or corrected. Their score jumped over 60 points, and today they are approved and moving forward with their home purchase. 60 points, that's not a small number. Depending on where your score sits, 60 points can be the difference between a loan approval and a denial, or between a good interest rate and a rate that costs you tens of thousands of dollars over the life of the loan. And remember, strategy beats rate always, but you need to be in a position where you have options. That starts with knowing exactly where your credit stands and what's actually on your report. So here's what I want you to do. Two things. First, go to rsrlinks.com/keysteps. rsrlinks.com/keysteps. That's our tool to help you get your financial house in order. It's a great starting point to understand where you are today and where you need to be. Second, go to rsrlinks.com/Sora, rsrlinks.com/Sora. This is where you can get a soft credit pull, no impact to your score, so we can take a real look at where your credit stands today and map out the right strategy for your situation. Credit doesn't have to feel overwhelming. With the right plan and the right timing, improvement is absolutely possible. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Your Credit Matters segment, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free.